Hello friends. In the last couple of videos prior to confirmation, we saw about bar charts, candlestick charts. What is the background for candlestick charts? What are the markets and the time frame in which we can use candlestick charts? While we use the candlestick chart, you all pretty much agree candlestick chart or candlestick patterns are mostly of reversal patterns. With candlestick charts or with candlestick pattern, can we predict the market? Can we identify the target of the price move? With candlestick charts, how can we set our risk reward ratio? Does the candlestick patterns go in silos? How can we use other technical tools in conjunction with candlestick charts? Candlestick patterns. All this we are going to cover in this video. Without much delay, come on, let's start our session. Candlestick charts. Candlestick charting essentials. Where did the candlestick charting techniques originated? You all aware, Japan. And in which specific market? First, the candlestick technique was used, futures market, and specifically in the rice futures, rice trading futures market. In 1700s, Munihisa Homa's techniques and principles were evolved into candlestick charting techniques. Japanese technical analysts used these techniques since the start of Japanese stock market from 1870s. What are the advantages of candlestick chart? Number one, single candlestick or a combination of candles together provide more reliable, more effective and profitable reversal techniques. How to construct a candlestick chart? Right in the screen, you see a white candle and a black candle. A white candle is bullish candle and a black candle is a bearish candle. Color doesn't matter. Here I'm using white and black. In some tools they use green and red. Hollow candle and filled candle. Depends. Changes from tool to tool, broker to broker, it differs. Normally in bar chart, we'll see one single line and two perpendicular lines representing open and close. However, in candlestick chart, it's much easier to understand. Quickly at a glance, we can identify whether it's a bullish candle or bearish candle. Now let us see what are the components of candlestick chart. Now in this, the entire filled portion is called as body. This rectangular portion is called as body. Area covering the open and close is covered with a rectangle and called as body. The extended line is called wicks or shadow. In this bullish example, market started at $30 or 30 rupees, whatever it is. Then it reached sometimes during the period of the day, it reached a low of 29 and it reached a high of 37 and ended at 35. Each candlestick represent a time span. For example, a candlestick in daily chart represent a single day. A candlestick in 1 hour chart represent 1 hour. Candlestick in 15 minutes chart represent 15 minutes of course. And another point we need to pay attention is close price. Close price are the price at which traders or institutional investors decide to hold the position by the end of the day. So it has more significance, the close price. And similarly, let us see an example for a bullish candle. In bullish candle, price open at 35. During the day, if it is a daily candle, if it is a candle in a daily chart, then during the day, the price reached low of 29 and price reached a high of 37. Finally, it closed at 30. Do candles always need a shadow or wicks? Need not to be. Price can close at the low. If instead of 29, if the low is 29, if the low is 30, sorry, the low is 30 and price also closes at 30, then we not be having any wicks or shirts. Hope you get it. If you still don't understand, let me know in the comment section. I'll try to answer you better. The ability to identify potential trend reversal is one of the significant skill to make profit. Your skill of understanding candle lines, patterns will increase that skill multifold. We have one basic objective. Basically, we have two basic objectives. Objective number one, buy low, sell high. Objective number two, sell high, buy low. There is a saying in the market, trend is our friend. Here we have two examples. We all agree most of the candlestick patterns are reversal patterns, isn't it? Now the reversal patterns can happen at number one and we take no action, or we can accumulate more stocks during these reversals. Why? Why don't we sell here? Because trend is our friend. What is the trend here? Bullish trend. What we are supposed to do? We need to buy. We need to accumulate. Right? That is what the literature says. That is what historical profitable traders say. So reversal patterns form at number two. Will stop trading. Will stick to our existing position, and from 1 to 2 we can accumulate. At number 2 again we can buy more. The chances are like that at number 2, if reversal candle forms, we can continue our position. Otherwise, we'll exit our position. Right? So in number 3, reversal pattern formed and there is no continuation of bullish trend. It's reversed to bearish trend. How can we determine whether we need to close our position or we need to wait for the trend to continue as a bullish trend? All depends on support and resistance. How can we determine support and resistance? Trend lines, moving averages, the latest high and low price will help us determine support and resistance. When I get a chance, once I cover all the chapters, I'll dedicate a video how to mark support and resistance. Otherwise, you can check some of my past video where I explain how to draw support and resistance line. In support and resistance, for example, at number 2, if we get a candle like this, we can identify it as a support. When we enter a trade, our risk is at the support area. Our stop loss is at the support area and our target can be above this high price. Or instead of having a stagnant support area, we can follow a trend line as a trailing stop loss. What is trailing stop loss? Refer my past video, I explained about trailing stop loss as well. Significant information about support and resistance, I covered it earlier in my past video as well. Old resistance become new support. If the resistance is broken and price move upwards, now our resistance is support. Prior support becomes new resistance. When the resistance line is broken and price come downwards, then now the resistance will become our support line is broken, the price comes downward, our support line is resistance line. Okay? Hope you get the point. Thank you for sticking till end of this video. Consider subscribing to my channel. The next video going to be pretty interesting. I look forward in the next video. See you. Bye-bye.